Stocktake is brought to you by Intelligent Investor, Australia's leading value investing research house. Get your free trial by heading to intelligentinvestor.com.au. The information in this podcast is current on the day of recording. It is general advice only, does not take your personal situation into account, and may not be suitable for you.
Good morning, everybody. My name's John Addis. I'm the founder of Intelligent Investor, and we have two guests this morning. We have Centreback Nick, who is having trouble with his audio in Newcastle. I don't think Newcastle's got anything to do with it, but this is our producer, Greg, who's decided to fiddle around with some new software. How you doing, Nick?
Yeah, good thing. So I think it's my own incompetence, but I'm battling through.
Never admit that publicly, Nick. Never admit that. Take a lesson from the Trump administration. Gaurav, also joining us from Sydney. How you doing?
Yes, I'm sitting here quietly watching all you clowns battle through technical difficulties.
We'll say that. Let's not suggest that you haven't had your own technical difficulties.
Yes, that was meant to be ironic because for those who don't know, no one has more technical difficulties than me.
Right.
I was going to say he's usually a culprit.
Yeah.
All right, we've got two subjects today. We are going to talk about energy prices and some of the stocks around the energy sector that we think are interesting. And we're also going to talk about volatility. Reporting season was crazy. Normally you'd expect 1 or 2% price changes on companies that maybe don't meet or surpass expectations. We saw some huge increases in reporting seasons. So I'm going to dive into that. But we're going to kick things off, and Gaurav doesn't know this, but I'm going to ask him to explain, as a way of understanding what's happening in energy markets, the concept of how energy gets set in terms of prices, which is the marginal pricing of energy, because I think that has quite a lot to do with the increases that we've seen in the oil price over the past few months. Gaurav, do you want to start there?
Jeez. Yeah, why not start with something small? All right, first, we need to distinguish between different forms of energy. Right, we're not going to run through the entire energy gamut in 5 minutes here, but
right.
The energy molecules are not the same. So oil is largely a transport fuel, and it can be transport via pipeline or shipping. So it's probably the closest thing we have to a commoditized global commodity that can be traded at a single global price around the world. Gas, of course, is very different. Gas is generally a generation fuel. It's used for electricity generation, and gas can only be transported via pipeline. So gas pricing is very regional. You can't have international gas prices. The gas price will differ from region to region, country to country, sometimes even state to state, depending on the gas infrastructure in place.
Yeah.
Yes, exactly. So the East Coast, in Australia, the East Coast gas market completely different to the West Coast gas market.
Yeah.
And that depends on the available infrastructure. So that's regional. LNG is really interesting because LNG takes gas and because it freezes gas and turns gas into a liquid, it makes gas transportable and instantly creates a global market for gas. So LNG, think of LNG as well, the name kind of gives it away, doesn't it? Liquefied gas.
Yeah.
But it's a proper commoditized global market. The only caveat with LNG, I'd say, is that because the infrastructure required is so capital intensive, both in the gasification and the regasification. So to export it and then to import it requires huge terminals, which are essentially giant fridging and defridging pipelines. They're generally sold on multi-decade contracts. So the price of LNG that you might see traded on the spot market won't always be reflected in actual company revenues because they'll be impacted by contract pricing. So they're your three main sort of forms of energy. Coal, of course, is a little bit different. There's just different markets for coal depending on quality. It is notionally a global market, but you take and subtract quality differentials for it. So when some of those forms of energy are interconnected. So the thermal generation energy, the thermal generation molecules, so coal and LNG, very closely connected. When LNG prices rise, you should expect to see thermal coal prices rise. And what's interesting at the moment, John, is that LNG prices have rocketed.
Yeah.
And thermal coal prices have only risen slightly. It's quite unusual.
It's very disappointing.
And for us who own a big chunk of coal in the portfolios and in our personal portfolios, that is a bit disappointing.
Yeah.
But it's surprising.
It is.
Because you'd expect those two to act together.
I wanted you to talk through that stuff, the idea of marginal pricing, because everybody thinks that, well, we're generating, some months Australia is generating 30% of its electricity from renewables. In the UK or France, there's a big component to nuclear. Both of those sources are much, much cheaper than gas, but it is gas that actually sets the marginal price. So that's why you get that relationship between coal and gas. But as you say, oil is a very different market. And if you look at what the price of petrol at the pump has done since the start of this war on Iran, in Australia it's up by between 30 and 40%. In the US, it's up about 20%. And in the UK, it's up only 5%. So what explains those differences?
I would suggest there's a lot of competitive, that tells you a lot about the competitive dynamics in those markets.
Right. So there's profiteering.
Unquestionably, at the retail and maybe at the wholesale level. Because these companies, so look at Ampol, for example, right? They would hold about $1 billion worth of inventory of oil, probably about 3 months of inventory supply. And that inventory is accounted for really with a lot of complexity. I still cover Ampol. So I'm familiar with the complex accounting. It is a pain in the ass. The accounting, once you understand the accounting, it's clear that instant movements in the price of oil should not be reflected in instant movements at the pump. But this time they were. And there's no other explanation for that other than the petrol companies just hiked their prices because they probably thought there might be some rushed buying and panic buying, which there was.
Yeah, okay. Yeah, Jefferies estimates that American producers will generate an extra $5 billion in cash flow this month alone from 47% rise in the oil prices. They reckon that over the years, if it stays at this price, it could be an extra $60 billion a year.
Yeah, that sounds about right, eh?
Are interest rates going up just because we're all paying more at the pump because Ampol wants to make more money?
It's not. No, hang on. Let's just get this straight. So the immediate short-term reaction of prices going up without the normal sort of month lag or so that would usually take for higher prices to be flowing through the inventory system, that is an example. So there's about 4 weeks of excess profits being made by the oil company, well, for the retail companies, right?
Right.
But there is no doubt that that the price of oil is now an open question. I actually think that I'm surprised the market is as sanguine as it is about oil. I would have thought that oil prices would be closer to 150. And between 150 and 200 would be my estimate. If I hadn't seen the prices, that's where I thought oil prices would go to.
Why do you think they're not at that level?
Well, I think the market is telling you they're pricing in. Look at the future curve of oil and the implied price of oil in equity prices. The market's made its decision, and it's telling you that they think that this is going to be a short war, and global oil supplies are going to return to normal within a matter of weeks or months. In a very short amount of time, everything's going to be normalized. Mm-hmm. And when you have that information, we can kind of think about alternative scenarios and how reasonable they are. I think that's an incredibly optimistic take. And we own oil equities. We own Karoon. I own Karoon personally. It's been a terrible stock to own up until a couple of weeks ago, really.
Yeah.
But I have not sold any of that, and I would not be selling. Ditto with New Hope, which is we also own and I also own. Because of there's a link between LNG and coal.
Right.
I would not be selling those things. There's a temptation, John, when you hold cyclical businesses and then you see a spike in the equities for that cyclical business. A sensible thing generally is to take some profit off the table. My advice at the moment, and I'm doing this personally, I'm not selling just yet because I think the tail risks here are actually very real, and they're not at all being priced into the equity. So the tail risk is that this conflict goes for longer. There's some sort of infrastructure damage or inventory damage. And an important point about oil is that unlike coal and LNG, which are substitutable, so when the price of coal gets too high, generators just switch over and they just go into LNG mode, and ditto the other way around too. So kind of there's a natural substitution effect between those two things, and it means that demand destruction on coal and LNG kicks in pretty easily. But in oil markets, there's very little substitution available, and so it only takes a small shortfall in supplies to massively spike up the price. And it requires a huge price to get demand destruction to kick in. And that means that you only need a small event, a destruction of inventory, a blow up of a ship, and a closure of the Red Sea port, missiles being fired into another shipping lane, and all bets are off then. So I don't mean to sound too alarmist, but I'm very surprised that markets are taking this so easily when I think the tail risks here are actually quite high.
Nick, have you? We don't normally talk. Nick and I do not talk about energy very often. So I don't know whether you've got anything to contribute. I'm only asking you because I don't have anything to contribute to what Gaurav just said.
No, I don't have anything to contribute really on the sector. I'd probably just make the point, though, there's a lot of things here we don't know, and it's been frustrating over the last fortnight to see so many sort of other investors out sort of as experts on the Strait of Hormuz, and it happens with every crisis,
Mm-hmm.
In the pandemic, everyone turned into virologists overnight. And I think it's just important to acknowledge there's a lot of things we don't know. And if this isn't your area of expertise, be very, very careful, moving your portfolio around based on, your own limited knowledge. But other than that, not a lot to add.
I will add one thing, not to that comment, but a point that I think is important to consider right now is that I think the finance sector places a very high premium on rationality and a desire to seem not just rational, but also calm and resolute. And all these ideas about independent thinking are very, very highly prized in the finance industry. So when you see a political situation or a political figure like Trump, where rationality is kind of beyond his reach, we tend to try and impose rational reasons over particular actions. And I see a lot of people doing that now, trying to make sense of this. And I just think it's the wrong lens to apply. If you try and impose a rational lens over these events, you're starting from the wrong place. I think the psychological lens is much, much more important. So if you're trying to guess what happens next, and you're trying to do that in a rational way, I think you're starting from the wrong point. So I just endorse Nick's comments there that we're not experts in any of this, but the idea that you can predict what is going to happen next in these situations is very, very difficult.
The idea of sort of maintaining exposure to these optionalities, the spike in these prices is a decent idea, just because the range of outcomes is wide. And you make a lot of money from being exposed to events that the market is not pricing in, and you might call that lucky, but as I always say, I'd much rather be a lucky investor than a competent one, and you kind of make your own luck.
Yeah, no, that's true.
The other thing, John, is that this whole episode, I think, should draw attention to how important energy is to modernity. Like our entire modern lives are built on an abundant supply of reasonably priced energy, and as soon as that changes, like the whole everything falls over. And I don't think in today's generally abundant world of no problems that we appreciate the importance of energy, and that might change when it becomes more scarce.
Yeah, I mean, one of the second order effects of this is we just published a story on our high quality hit list this morning. And we've put Eagers Auto on the hit list for the first time, and it's not far off our buy price. But one of the interesting things is that they're a big reseller of BYD electric vehicles, and I think they increased their sales by 63% in February alone, year on year. you can see that going much, much more quickly. This is the best advertising that we're going to get for a switch to EVs is a higher oil price. And I think the governments are going to get caught by this. There's just not enough chargers around for the demand that's going to be there.
That's a great example. I actually called, I spoke to a friend of mine who knows, through connections, he's hooked up with what's happening in BYD, and he said that sales in his particular dealership have just exploded, and they had inventory that they weren't sure they're going to clear, and now they're out. And they're selling every car they can get their hands on.
And one of the other second order effects is that because of the trade war and the tariffs that, the punitive tariffs that the US have imposed on China, is that Chinese car companies are now just sort of ignoring the US altogether, but they're really, really pumping out a lot more vehicles into South America, into Europe, into Australia. They're selling they're making, I think, global car demand is about 1 million EVs a year. I think that's right. But that is going through the roof. So we're going to see a lot more Chinese cars on the road, and I think that's good for Eagers. So I should declare that I'm a holder in it. I think you are too, Gaurav.
I bought back
in, actually. I sold out, but I bought back in. Nick, do you own Eagers?
I don't own Eagers, but it's one I've got my eye on. It's fallen a fair way. I know.
Can we stop for a second and berate Nick? We went there.
I know. Come on.
We checked it out. We all marveled at how amazing the operation is, and you still didn't buy any stock. Jesus, man.
No,
come on.
Oh no.
And don't forget that when everybody buys a new EV, is also going to trade in their old combustion engine vehicle.
Yep.
And that's going to be 2 different sales that Eagers are going to get.
Correct.
From one car. One transaction.
Yeah. The other thing I just point out, I don't know if you guys saw the February sales data for Australia, but China, for the first time in 28 years, has taken over Japan as the largest supplier to the Australian market.
Wow.
Yeah. Yeah, incredible.
Pretty crazy. Yeah.
That is mad. Absolutely mad. Okay, we are going to move on to our second subject, and we are going to talk about volatility. We have just finished reporting season. We still have a few results to get through, but we're largely done. Nick, I'll start with you. There were some incredible movements in some of the stock prices that you covered. Do you want to talk about a few of them as a way into talking about why these movements are so large compared to what they were even 3 or 4 years ago?
Yeah, I think it's probably the place to start is this reporting season was different because of everything going on outside of reporting season. So you've had like high quality businesses, growth companies, technology businesses, software companies really fall over the last sort of 3 to 6 months based on fears around AI. You've had massive share price expansion in the commodities or the mining sector, so particularly gold. And then just after reporting season, obviously, we've had this war with Iran, and that's disrupted share price as well. So there's lots of things that aren't necessarily the earnings that are moving stock prices. I mentioned the other day, I think on our call on Monday, that you can become a little bit desensitized to the movements at the moment because I think I brought up ProMedic as one of the examples, and its share price has been up or down 5% almost every day for about a month. Mainly down, but it's kind of crazy. But these moves are happening throughout the market. So another example, I think I wrote about in our reporting season review was Life 360. And this isn't a company we cover, but I sort of keep an eye on it. And after its result, it rose 10%, but then finished the day down to 17%. So in 6 hours, there was a 27% move in that share price.
Wow.
And so there's a lot of things going on. There's a lot of momentum trading. There's a lot of people trying to get out of positions or get into them. And it's really hard to actually know what to make of it all, except that, volatility is back, and it's sort of back in a really big way. Even like results like Woolworths, that was a decent result, but it was up 12% on the day. That's quite a big move for a company of that that size. CSL was similar. I think it sold off a fair way. And so, just the moves around reporting season, they seem to be much larger than they have been previously. I think what was probably just a little different, at least in the stocks that I cover, even the good or in-line results weren't necessarily rewarded with higher share prices. But if you missed or if there was any weakness, stocks were off, 15 to 20% on the day, and sort of continued to sell off afterwards. So anyway, there's a long way of saying that there's a lot going on, and it's really hard to know where to put your focus at the moment.
Yeah, one of the games we play is in reporting season when a result for one of our stocks comes in the morning. We need to, for the funds, need to send a little summary of the result, and we generally include what we think market reaction is going to be. And it is really interesting to get our take of what market reaction might be compared to what market reaction actually is.
Yeah. Wrong.
But
everyone I've seen this reporting season has been massively understated, or like in completely the other direction.
That's right.
Yeah. Do you remember being in the office? I think it was maybe the 25th. Anyway, it was the day of the WiseTech result.
Yeah, I was WiseTech.
And I remember looking at that result, and I said to you guys, "Oh, this is a shocker." Nath was like, "Oh, this is terrible." Like we all sort of agreed. And you can point through all these things. Cargo-wise, revenue was slowing down, so that's its core software. They'd announced some layoffs. It was the first time you saw actually how much debt they now have on the balance sheet. So they're levered about 4 times compared to their EBITDA, and we think their EBITDA is quite aggressive, so it's probably even higher. So there's all these things going on, and then the stock was up 10%. And I was like,
well, the three of us, we were taking bets about how low it would go. I thought it would fall double digits, and it was up 10%.
All right, so why is this happening? Let's try and answer the question, because these moves seem crazy. They seem completely contrary to what you'd expect, and we've all been doing this a long time. We normally see that the market is kind of rational, and often when what we think is a good result normally produces, a bit of a share price bump one way or the other. What's going on? Why is this happening?
Yeah, Nick, tell us what's going on.
Oh, yeah. Speak about getting the hard question. Well, I mean, I might answer it how I answered the energy question. I don't know. But no, I think...
All right, we'll have Graham on the podcast next couple of weeks.
Yes, yeah. I'm not adding much today. Look, I think some of it is there has been as I said at the start, there's been massive share price moves for a lot of these companies. So WiseTech's share price has fallen from $130 to I think it was about $45 on the day it reported. So some of these reactions that you look at and you go, "Oh, why is the stock up?" Maybe just relief rallies. The share price may have been down so much that almost maybe that last seller is gone. That doesn't mean that it's cheap by any means. But so some of it might be that. I think some of it is also in the larger caps, like just people, I think I wrote about it, and sort of people are sort of seeking safety blankets, so they go back to what they know. So if you look at CBA's result, I don't think anyone would expect that stock to have been up 15%, or I think maybe it was a bit over 10% over 2 days. But it goes back to where you feel safe. Maybe Woolworths got a little bit of that, although the result was much better than its previous result. So there's a lot of other things going on here that aren't necessarily fundamental, and that makes it difficult. So I don't know if that answers your question, John, but probably doesn't.
Well, kind of. Gaurav, why don't you have a crack at this, because it is kind of confusing. I'm perplexed by it.
Yeah, well, there's 2 clear things that are happening in the markets. One is that bots are clearly dominating. They're getting larger in terms of volume, and they're getting more active. And you can see that when we trade as well. I always notice bots when I buy and sell.
How do you notice the bots?
Well, if I put a trade order in, all of a sudden the bots are all over it, and they're swarming around the price, trying to get a little bit above or a little bit below. And if I change the price, the bots are there again. And this is not always just in large companies. This is sort of in mid caps as well. So I think there's a lot of bot trading. But the other point is the passive flows as well. This is unthinking money that has to react to share prices and almost by definition just magnifies the whatever reaction was going to happen. It's now worse or better depending on direction because there's so much unthinking. There's a flood of unthinking money that's acting on any particular bit of information. I should add that's great for us active investors because it means there's a greater pool of unthinking investors. Like people are just buying and selling because they have to, and then that generally leads to inefficiency, which is good for us. So I'm not complaining about this, but I am surprised by it. A few other examples. I mean, Woolies is a top 3 position for me, and I was stunned to see the share price up 13% on the day. I could not believe it. And by contrast, the PWR Holdings, I thought that was a completely ho-hum result. Share price was up. Lovisa, messy, complicated. Share price got smacked. It's become very difficult to predict the direction, let alone the magnitude. And that's hard on the day with an analyst hat on, but with an investor hat on over the long term, I think it does lead to more opportunities.
Yeah. I think we're seeing more opportunities because of it in reporting season.
Definitely.
Yeah. So this is a good thing. You need to have an idea of what stock is really worth to actually take advantage of this increased volatility. And that's where I think we can help. But I think we're going to end it there.
Can I just make one more point, John?
Please do.
Yeah. Well, so the more I do this, when I first got into investing, I really thought this was a game of intellect, that you had to know more, work out more, calculate more, and outthink everyone else. I thought that was the way to outperform. But the more I do it, I realize this is not an intellect game; it's a psychology game. The more you can control your emotions, and the more you can exercise cold rationality, I think that is the edge. And I don't know if that's changed or if that was always the case, and it's just taken me 20 years to realize it. But I think that's very clear to me that this is for people. This game is for people who aren't smart but can exercise can control their emotions. And I think that explains why all 3 of us do it as a profession, because I think that applies perfectly to all 3 of us. Maybe not Nick.
Buy Eagers and he'll change his view.
I'm thinking of Eagers. Unbelievable, Nick. What a terrible decision. You were right there.
Talk about a calm response.
Yeah, that's right. Anyway, okay, I think that's a great point. Look, you need to be good at both. I think the psychology is truly important, but you also need to understand the nature of the businesses that you're doing. You still need to do the work. A lot of the bots aren't really doing the work, and I think that.
But that's easy. That's the easy part. I think anyone can learn how to do that.
Yeah, I don't know. I don't know about that. I think there's a lot of time and effort involved and a lot of experience that needs to be accumulated in order to do it well. But for people to prepared to put the effort in, I think it's an acquirable skill. The psychology is the thing that gets people out of trying to do this themselves, because it can be very, very damaging. It can be brutalizing, and it just puts people off. But if you can get past that and understand your own psychology and how it plays out and modify it as time goes by, then you're in a good position to manage your own money, I think.
Yeah.
All right. I'd like to thank you both. We're going to call it a day. If you do want to have a look at our high quality hit list, please visit intelligentinvestor.com.au and sign up for a free trial. And we will be back with you in 2 weeks with Graham this time.
Oh, thank goodness. Someone who knows something.
Hopefully he'll own Eagers. All right. Thank you very much, everybody. We'll speak to you in 2 weeks.